Hi, this is Andy Pratt, partner and director of investment strategy here at Burney Wealth Management. And I'm joined today by Bijal Patel, another partner and senior wealth advisor on the team. This is Byte Size Retirement, where we take common retirement planning topics and break them down into bite-sized 5-minute pieces. These videos are not investment advice or tax advice, but hopefully help remove some mystery and provide a solid foundation to plan off of. Remember, while we may be explaining a topic in 5 minutes, don't take 5 minutes to make any of these decisions. So today, I wanted to take a moment to talk about bond investing. This is something that is top of mind to many retirees because oftentimes they get advice to increase their bond allocations in retirement. But at the same time, plenty of people are looking at the lower return environment and wondering, do bonds still have utility in their portfolio? So I wanted to talk about those topics today, all in 5 minutes. But first, Bijal, please explain, what is a bond?
Sure, that's a great question. If I break it down to its simplest effects, a bond is when you lend your money to either a company or to the government, right? And in return, what they will do is they will pay you back interest. Typically, this interest payments will come semi-annually to you. And at the end of the term, you're promised to get your money back. That's a simple bond, right? But Andy, can you describe what is a bond used for?
Yeah, absolutely. So bonds are typically used as a vehicle to generate some level of returns in an investment portfolio, but also reduce overall risk. So we know stocks are the most risky asset class in investing. Bonds are considered the less risky asset class. Bonds are typically used as something like a foundation or like a rock of the portfolio, something that isn't going to move very much when the stock market moves, but does offer some protection. Now, that's kind of bonds in generalities, but there's different types and different, uses of different types of bonds. So Bijal, can you explain what different types and styles of bonds are out there?
Sure, absolutely. When we think of bonds, they're usually broken into two segments. One is you can lend your money directly to the government, or you can lend them to corporations. And in doing so, then people will take a look at what's the quality, right? There are definitely some institutions that are more stable than others. And the trade-off is then for the more stable ones, you get a lower rate of interest. For the ones that are more riskier or in that junk bond status, you potentially could get a higher rate of return. And then how long do you want to lend your money to these institutions? And that can range anywhere from 1 to 30 years, also known as the term of the bond itself. So those are the characteristics of bonds. And then in terms of the pricing of bonds, Andy, do you want to talk a little bit about what affects a bond's return?
Yeah, definitely. So there's a couple of things, really two main drivers of bond returns that will dictate the experience that you have in them. So the first one is interest rates. So bonds are inversely correlated to interest rates, meaning that when interest rates rise, bond returns fall, and vice versa. When interest rates fall, bond returns rise. There's that inverse correlation there. So that's going to be one thing to keep an eye on, especially with your longer term bond investments. But the other thing is bankruptcy risk. So bonds are a loan to the government, as Bijal, as you said earlier, or a company, and companies can go under, they can go bankrupt. And so there's a risk of losing some money. Bonds are a little bit more protected from bankruptcy than stocks. Because they do typically have preferential treatment over stocks in terms of return of capital, but that's a risk as well. So given that and given the different types of bonds out there, Bijal, how can we invest in bonds?
That's a great question. So just like a stock, it's possible that you can invest directly in an individual bond. Unlike individual stocks, they don't necessarily trade on an open market and have free liquidity in terms of understanding the pricing. So you have to do a little bit of research when you go to buy individual bonds themselves, but it can be done. But in today's environment, in terms of diversification, and we believe in this at Burney Wealth Management, is looking at either a low-cost bond ETF or mutual fund. The benefits here are that you get much broader diversification and many different types of bonds, right? So as opposed to laddering your allocation with a small dollar amount of only potentially getting 1 or 2 bonds in your portfolio, by looking at a mutual fund or an ETF, even though the costs might be slightly higher, you're getting much more diversification within the bond allocation itself.
Yeah, that's great. Thanks for that. So I think the bottom line here, Bijal, and I think we got this done just inside of 5 minutes, but if you have any questions about your bond investments, or if you're investing the right amount in bonds, please feel free to give us a call here at Burney Wealth Management. We're happy to give your investments a second look. Thanks again for joining us today, and best of luck out there.
Take care.